In this video, I'm going to show you exactly how the MACD indicator combines both a trend and momentum indicator into a single easy to read tool. Then I'm going to give you one simple filter that elevates it from a good indicator into a complete high probability trading system. So let's be real, the internet sold us a bit of a lie. And that lie is that more indicators means more confirmation, which should mean better trades. But what's the reality to that? Well, you add an RSI to check momentum. Then you add a couple of moving averages to confirm the trend. Now you're going to throw on some Bollinger Bands to see how wild the market is. And before you know it, you can barely see the price through the web of conflicting data that you've created on your chart. So you see a beautiful buy setup on your moving averages. But the RSI is saying, oh no, the market's overbought. So what do? You freeze. And then, of course, the market just goes up without you. So the next time you decide you're just going to ignore the RSI and just take the trade, and then you're going to watch the market reverse, hitting your stop loss. So this becomes that vicious cycle you've heard about called analysis paralysis. It's not just about missing a good trade. It's about getting tricked into a bad one because you're forced to choose which indicator to trust. So that constant second guessing, it kills your confidence, makes you trade emotionally, leads to a roller coaster of results, and it feels more like gambling than trading with a clear and decisive edge. So that's where the MACD comes in. So if you could use one tool that measures both trend and momentum at the same time, would you do it? Probably, right? Well, that's what the MACD was built to do. And that just simply stands for the moving average convergence divergence. And this was developed back in the late 70s. And it's a pretty popular trading indicator. So let's break down 4 parts. And you're going to see why it's pretty much a powerhouse. First, you got the MACD line. We can call this the engine of the indicator. It's just the difference between a faster 12-period moving average and a slower 26-period one. When the line is going up, it means short-term momentum is overpowering long-term momentum, right? That's a bullish sign. When it's going down, the bears are in control. So think of that as your main trend and momentum gauge. Then there's a signal line. This is a 9-period moving average of the MACD line itself. And its job is just to smooth things out and give us our most basic trade signal. When the faster MACD line crosses above the slower signal line, it's a classic buy trigger. When it crosses below it, it's a sell trigger. And then you have the histogram, those little bars on the indicator. That's it. And this shows you the distance between the MACD and the signal lines. So when the bars are getting taller, it means momentum is strong and it's picking up some speed. But when they start to shrink, it's just a heads up that momentum might be fading. And often it does this even before price reacts. That's like a speedometer on a car. It's your momentum speedometer. And finally, the zero line. This is the center line. When the MACD is above zero, it confirms an overall bullish environment. Below zero, the bears are in charge. So in just one clean window, you get trend direction, you get momentum strength, you get some clear trading signals. So it's a pretty good analytical tool. So at this point, you're probably thinking, well, if it's so amazing, why is everyone just not using a crossover? And that's a good question. Because the answer is MACD's one major weakness is false signals, especially when the market is going nowhere. Because it's made up of moving averages, it's going to be a lagging indicator. In a choppy sideways market, the MACD and the signal lines, they can whip back and forth. It creates a pretty frustrating series of small wins and losses that can slowly bleed your account dry. This whipsaw, this is where most traders get wrecked when they use the MACD, but we can fix it. So we're going to filter out most of the noise. We're going to add one more thing, and that is simply the 200-period EMA. And this has historically been seen as a definitive line in the sand between a long-term bull and a long-term bear market. So if price is going above the 200 EMA, the big money sees the trends up. If it's below, trends down. So when you pair the MACD with the 200 EMA, you have a simple but a pretty rock-solid system. The 200 EMA is going to tell you which way to trade, and the MACD is going to tell you when to pull the trigger. So here we got to turn in some rules. So when you have a trading system, it takes the emotion and the guesswork out of the equation. You're not thinking, should I take this trade? What you're asking is, are my rules met? Yes or no? And here's the plan. Let's think of a long trade. The price has to be trading above the 200 EMA. If not, we're not even thinking about buying Number 2, the entry trigger. We're going to wait for the MACD line to cross above the signal line. But here's the key. This crossover has to happen when both lines are below the zero line. Why is that? Because a crossover below the zero shows that the market was recently bearish, but now is showing the first signs of reversing back in line with a main uptrend. And this is a higher probability setup. And I call this Rule 2A. So the MACD crosses happen and we get a trend line break. So that's a little extra confirmation that the rhythm of the market has changed. We had a pullback and now we're seeing a resolution. Not only an indicator, but in price action. Rule 3, the exit plan. Our stop loss is going to go below the most recent swing low before our entry or the last consolidation area. There's a little bit of nuance in this. For our take profit, look for a reward to risk ratio of 1 to 1.5. So this means for every $100 you're going to risk, you're going to look to make $150. For short trades, the exact opposite. Price has to be below the 200. No exceptions. We're only looking short. Wait for the MACD line to cross below the signal line, and this has to happen while both lines are above the zero line. And again, Rule 2A, we have to see a trend line break. Our exit plan is the exact same thing, 1 to 1.5 risk-reward ratio. So let's take a look what this looks like on a chart. So we're looking at a stock. First things first, we have our 200 EMA. We see prices above it. Boom. Rule 1 is met. We're only looking for buys. Now we watch the MACD. The price pulls back a little bit, drags the MACD and signal line down below the zero line. So the market is just taking a breather, right? Then we see it. The yellow MACD line makes a clean cross up and over the red signal line, all while it's still in negative territory. That's our entry signal. So Rule 2 is met, and then we see the trend line break. Take our long trade. Set our stop loss below the low of a pullback and place our profit target at 1.5 times our risk. A few days later, our profit target is hit. The market came to us. We don't force it. We're not guessing. We followed a simple 2-indicator system. So let's circle back to where we started, that cluttered chart and that confused trader. The solution is not to keep adding more tools. It's about choosing the right tools. And it's about understanding that one powerful indicator like the MACD. The system is going to give you a clear read on both the market's long-term direction and the short-term momentum. It cleans up your charts. It simplifies your decisions. Gives you a rule-based edge that you can rely on. Now, so I'm going to be completely transparent here. You need to look at hundreds of charts every week. Okay? Find what the charts look like that go on to winning trades versus the ones that don't. Find commonalities in price action and volume. You need to do that homework. You just can't trade this out of the box. So if this video helped you see the markets a little bit more clear, do me a favor, hit the like button. Subscribe, click that notification bell so you don't miss our next video. We'll talk to you soon.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPic's full risk disclaimer and privacy policy.